Today, we're discussing using profit first to build a healthy company. So the Contractor Success Forum discusses financial strategies for running a more profitable, successful construction business. So, Wade, do you know that we have show notes? Did you know that today? We
I
always
knew
have
we did. I don't really know what they are or where to get them, but
Yeah, do you
I
know
knew
how
that
to
one.
get to those things? It's so cool. I didn't know for so long. You like go to the podcast thing and you like scroll it up and you push it up and the show notes, they're right down there and below there. So go do it and share. There's a share button down there too. Did you know there was a share button, Wade?
No,
Well,
honestly, I didn't.
down there, you don't even have to scroll for this one. Go right there, the bottom, there are 3 little dots. You click on that and boom, up pops this thing. And there's this little box with an arrow. And it says, what do you think it says, Wade?
I suppose it
Share.
says share. Yeah.
It says share. And so you hit share and it lets you email it to your best favorite person or the person you think that needs this most. So anyway, just thought you guys would want to see that, or go to contractorsuccessforum.com and subscribe to our show. So there you go. That's how you do it, Wade. Did you know that? I didn't know that all the
Now I know.
features are there. All right.
I
Well,
learned something today.
you did. We both learned something. So now that's the show's over. No, we'll get back to the profit first part of the show. So I'm Rob Williams, your profit strategist with Iron Gate Entrepreneurial Support Systems, driving profit in your businesses with decades of vertical integration as a contractor, manufacturer, aviator, and financial strategist in the construction industry. And Wade Carpenter is here with Carpenter and Company CPAs, helping contractors nationwide to become permanently profitable for over 30 years. And today we're so sad because we're missing our buddy, our underwriter, Stephen Brown. He is a construction bond agent at McDaniel Whitley Bonding Insurance Agency with over 30 years of experience underwriting and placing bonds for you as a contractor. But he's here in thought listening to us right now as this plays. So today, Wade, we're talking about using profit first to build a healthy company and following up. What just happened? What two interviews did we just have that were so cool?
Well, after we did the podcast with Mike Michalowicz and Ron Saharyan of Profit First, Stephen asked some great questions, and he asked it from his perspective as a bond agent and from the bond underwriter. And it actually sparked a discussion between all three of us about his perspective, and maybe we haven't explained it to our listeners as well. And so I wanted to expand on some of the things that Ron and Mike said
Yeah.
about profit.
Yeah, it's great. So what do you think those our biggest takeaways on that about why profit first, or what you do with that profit? What do you think's the best thing to talk about?
Well, I did want to start with the profit thing. I mean, I would just throw out a quote for today. The Jim Collins, the guy that wrote Good to Great.
Right here on my bookshelf.
Oh, okay. Well, I didn't know that. I should have had you pull that out. He said, profit is like oxygen, food, water, and blood for the body. They're not the point of life, but without them, there is no life. A company can't survive very long without profit. And I think Stephen's take on, profit first and the name profit first sort of implied to him that it sounds like a greedy owner trying to take everything out of his business, not leaving anything in the company to bond off of, or let's be a greedy owner and take it all from our employees.
Yeah, because it's not the greedy owner thing, it's the airplane thing of put your mask on first, the aviator comment that I had
Yeah.
there as a pilot. You gotta be able to stay in business for everybody. You've got to make sure the company is healthy before it can take care of everybody else. It's not don't give anything to everybody else, but sometimes I use the word appropriate profit first. No.
Right. I mean, too many times the owner, they're struggling to survive. And sometimes you see the receptionist takes home more money than the owner.
Right.
And sometimes we use that as a, badge of honor. I didn't take anything out of here. And we constantly plow our money back into and reinvesting our profits. So buy some more equipment or whatever. thinking it's going to pay off one day.
Yep.
And going back to your putting your mask on first, the owner needs to take care of himself first. Otherwise, he can't take care of the company.
Yeah, that's right. I mean, who is the most valuable member of most of these contractors? Who's their best employee? It's usually the owner. It's the owner of thing, and he ought to be rewarded for working in there. Sometimes, like in some of the stories, the wife wants them to quit because they're not bringing
Yeah.
home enough money. That may have happened in my house once or twice. When
Well, I
I
mean, we
didn't have
all
the
feel
money.
like you see it all the time. Somebody gets the entrepreneurial bug and they end up taking home no more than what they were making or even less working for somebody else. And it's
Yeah.
sad.
Well, my favorite thing is explaining to my wife how I didn't bring home much money, but at the end of the year, then I had to pay a huge tax bill. She's like, "What? We didn't
Yeah.
even bring that much home. How are you paying that much in tax?" I'm like, "Well, you see that big saw over there and the other thing that hadn't depreciated yet, and we're growing." And I didn't
Right.
even get that far. It's just like it wasn't a great conversation for me.
Yeah.
This was
Well, I
before
mean,
Profit First, by the way, everybody. So
right.
the before
And
picture.
I can say the same thing. For 30 years, I'm a CPA. I'm taught profit is there's generally accepted accounting principles. IRS has their own definition of profit. There's accrual basis, a percentage of completion basis for contractor. But in Profit First, we define profit. I'll let you answer that. How do we define profit, Rob?
Well, I profit is the cash that you take out of your business as cash or accumulate in your
Retain,
business.
right, right. We look at profit as cash that increased over the previous year.
Yeah.
We strip out all you got to pay back debt, you got depreciation, those kind of things. So we look at it a very different way, and the behaviors are. I mean, personally, after 2 years of doing it in my own business, I've transformed my own business by doing it.
Yeah. The value, I was a finance major and in the real estate and stuff. And the value of something is the net present value of the cash flow of the
Hmm.
return, not the accumulation of assets inside there. It's the value of something is the net present value, the value today discounted back of all the future cash flows that you get. Value doesn't count when you leave it in the business. It's not
Right,
until you take it out that you're beginning to get value from that.
right. For all these years, I've taught people to run it the way I was taught. Know your numbers, learn a balance sheet, learn a P&L, your cash flow, and that's not bad advice. That's great advice, actually. I still advocate that. But what comes down to happening is what people do. Their innate behaviors are around cash,
Yeah.
and we make unconscious decisions around cash all the time.
Yeah. So we're back on the bonding, and when we have a profit account for you guys out there that may not have listened before, we take our revenue account and then take your profit first. So you take, if even it's just 1%, maybe it's 10% that you're taking and you're putting in this profit account. And then you have your owners paying your tax and your operating expenses. What do you do with that? That's the great mystery. There's so many different things that you can take with that, and I love our bonding discussion. So maybe we'll have explore that in a little bit more depth. So when you take your profit and you put it in that profit account, what do you do, and how does that help on your bonding?
Well, I think a lot of people don't realize it's like, yes, we are going to put aside money for profit, and every dollar that comes in, a certain percentage is going to go to that. And it goes back to the same discussion. Profit does not happen. It's not an event. It's not after December 31 and then they come sit down with me in March, April doing their taxes and they find out how much profit. Profit's got to happen every single day.
So if we start by putting it into a profit account, then we might distribute it from there based on advanced profit first strategies and advanced accounts. But we were discussing working capital in the definition of it. But you put it there and just hold it. Maybe you call it put it something called a working capital account, which brings up what in the heck is working capital and what counts. How do you use that towards improving your business so you're able to grow your company? Not just
Yeah,
sales. It takes cash to grow your company as a bonded contractor.
well, any contract, any business for that matter, to
Well,
grow
that's
it,
true because you
it
can't run
really
your
does
company.
take cash and
Yeah.
working capital to do it. What I don't think was said when Mike and Ron were on the podcast was our philosophy in Profit First is let's accumulate this cash and we're going to do something with it every quarter. The idea is like, let's not take it all out. Let's leave maybe half of it for retained earnings. But then again, the owner deserves
Which
a profit.
retained earning is what, Wade? Is that the money that you well, that's actually retaining in there, not taking out.
Yeah, the money that we're leaving in the business to grow it.
And now
You
now
know,
back
but
to your other half. I was wondering
right, right.
I was just thinking most people are like, "What the heck does that word mean?"
Well, I sometimes do that, and I
Yeah.
apologize. The owner is taking a risk, and first of all, we need to replace our salary first. We set aside a little bucket for that. We put aside money for our taxes, but in this profit number, we've taken a risk. Just like if you invested money in the stock market or whatever, you want that money to pay you back something. And part of the profit should be a reward for the owner for taking the risk to jump out in business, and he should enjoy those. So we do advocate that the owner should take something from it, but not at the expense of building a healthy company. So we can talk about that.
Yeah, there's so many things that even as you were talking, I was thinking all the different things I've seen people do and even mistakes. I hope this isn't off topic, but I've recently seen somebody when they're putting that in there, they're reducing long-term debt with that. And then I'm thinking, oh, you may have really messed up. Did you calculate how much you're doing? Because can you get that long-term debt back? You may need that working capital. Think about your bonding requirements and your working capital needs before you pay that long-term debt back, which hopefully our accounts kind of help us do that. Do you want to talk about that for a second? That's just one common thing I'll see besides buying a truck. That's
Yeah, I mean, normally if you're where you want to be in your business, we would leave maybe half the retained earnings in there. But if you're far in debt, and this is why a lot of people say I can't start Profit First. I'm too far in debt. I'm not making any money. Profit First is exactly when you need to start that. And what we do with the profit is at the end of the quarter, we will take that profit and roll it into that debt and knock down that debt. And with Profit First, I don't know if you want to talk about it. Rob's also a mastery level Profit First. I think he's a little humble and he doesn't throw some of these things out there sometimes, but he talks about the Dave Ramsey debt snowball. We
I was
start with
just
that.
thinking that one. That's where I was going too.
You want to explain that?
Well, the first thing I was thinking about is the Dave Ramsey rice and beans. Rice and beans. That's on an individual basis. You actually can't go to rice and beans and still run your company, though. So don't put every penny you've got towards your debt. That's the first thing. You can't put all your money into the debt snowball. First, you've got to figure out what you need to run your business and keep there. And then what you can put towards your debt snowball. And the debt snowball says don't start with your highest interest rate, which that's what you want to do. You start with your smallest debt first. And when you're paying those off, there's a logic to it. Wade's got a great demonstration that we did for a contracting group the other day in a live seminar. And you pay down the smallest ones first, but you keep making that same payment. And when that small one disappears, then you can take that full, let's say it was $500 in that, and apply that towards the other one and say, I know in your example, we were paying $4,800 a month. And if you pay that small one down first, it actually somehow with the math erases your debt faster, but it's also a psychological impact. There's a little bit of both.
You're
Did I
taking out
explain
your
that
minimum.
okay?
I mean, you take out your minimum payment on your smallest one, and then you add to that, and it becomes increasingly. It feels good when you got 5 accounts, then four
Yeah.
accounts to pay at three, and then Profit First has their spin on what do
Yeah.
we do with that.
Yeah, yeah. I guess let me go back. I guess what I didn't say is, yeah, because you were erasing $300 or $500 a month. And then when you get rid of that extra 300 minimum payment, then all of a sudden you're erasing $800 a month of the debt when that one disappears. And then maybe that next one has $1,000 minimum payment, and 800 goes to $1,800 a month that you're erasing. And when you start paying that down on your biggest one first, it doesn't add up that way. So it adds up to less than that 1,800. It's not intuitive to me
Right.
that it works. But just trust us. Pay the smallest ones down first and get rid of them so you can but keep paying that same amount even though your minimum payment goes down.
Well, I mean, you have like 7 credit cards or something like that. You never pay any of them off, and sometimes you give up and you keep
Yeah.
paying on those minimums. And the profit first spin on that is we use the debt snowball, but every quarter we're going to take, it may be 95% of our profit and put it towards that debt.
Mhm.
Debt is not a bad thing when you use it properly. If you leverage the money to get another machine that you can use, but too many times people will go buy a pickup truck on December 29th just to knock their taxes down. And the one revelation, I guess, of Profit First is debt is an expense that you paid in the past that you've got to come up with in the future.
Yeah, oh, so
You've got to have that profit to pay it back.
yeah, so let me ask you this question because I get it all the time. When you pay down your debt, is that on your profit and loss? Is that an expense on your P&L when you're paying your debt off?
Absolutely not. I mean, maybe the interest is, but the
Right.
principal, and that's where we're trying to get to is like, what is the cash basis? How much did the cash go up from year to year? We're trying to define it so that these contractors that struggle so hard to take something home actually get to take home what they deserve.
Yeah, and it's not that when you bought that truck that you didn't get to expense the truck, but the reason that your debt is not an expense off of your taxes is because you already deducted it in the beginning. If you got a full deduction that first year, there's some tax benefits. If you call it a benefit, I think it's almost a reverse logic trick to fool you. You take it all in that beginning. So when you're paying down $20,000 a year of that, if it's $100,000 loan, well, you already took the whole $100,000 perhaps and expense it out that first year instead of spreading it out. And now all of a sudden you got a $20,000 more tax bill in the future that you hadn't allowed for. I see that
Right.
all the time with
Yeah.
very smart people. And some of these people are numbers people, but not CPAs. So I'm sure you're not going to get it just from that explanation, guys, if you're listening. But just remember those debt payments, except for the interest part is deductible. But when you're paying down those big debts, it doesn't come off your taxes.
Yeah. You continuing to pay it. And the point of the talk that me and Rob did the other week for that trade organization was there are business cycles in construction and things could turn south tomorrow. And the ones that survive are the ones that are healthy. And so that can build some working capital, that can build up some cash.
Yeah.
And when you do have cash, you can take advantage of opportunities when things go down, or you can survive it where other companies probably can't.
Yeah. What's so scary is I see people maximizing their cash flow in these big upwards years, their current cash flows with the debts and stuff, and it may help them grow. But what's really scary is most people don't realize that they are putting a cash obligation in the next 5 years in the future,
Yeah,
and then they may
exactly.
not have that income, and then they're gonna go out of business, and when people are doing it, all they're hearing is their tax savings that year, and they don't realize the hole that they're digging for themselves.
Exactly.
That's scary.
Yeah. I think that hopefully proves the point that profit first is not about like, let's take it all out, because that's not at all what we advocate.
Yeah, so I guess getting back to what do we do with this profit, and what is this profit account? Let's make it clear because I know Stephen made a great point. If you have something, and most people probably don't call it a bond account, they may call it a working capital in their profit account. That's not money that you save to pay your bond.
Exactly.
That's
Yeah.
not what it's
I
for.
think that was kind of a miscommunication on that. But
Do the bond people realize that a lot of times they don't pay that bond? I don't know if a lot of contractors,
well,
if they're
usually
newer,
it'll
they may
like,
not know that.
you get a draw up front, and you put that bond premium in your
Yeah.
upfront payment
Typically, if the bond is required, that's passed through to the project
to the job.
owner.
Yeah,
I mean, maybe there's a bond contract for that, but that's not what we're talking about. This is a profit account to help your working capital. This is not saving to pay your bond, guys. This is a working capital account
well,
to make your balance sheet healthier. That's what it's about. And understanding when things are going great, how to build a healthy company and not how you pay the least amount of taxes this year and put yourself in a really big hole to have to pay that. Because some of these tax benefits, it's almost like getting a loan against the future taxes
right.
that are coming up in the next 5 years. When you get an accelerated depreciation on something, especially if you've got loan payments out there,
Hmm.
that means you're getting the next 5 years of deductions all up front. So you're borrowing against
Your
those
future
next
profit.
5 years.
Yeah,
People don't realize that they're not making that. It's not extra tax. You're just getting it early, which is great. But if you spend it, you're going to have to be paying more taxes the next 5 years. And people
yeah,
don't realize that part.
yeah. And one other point I wanted to make, whether we call it a bond account or what, we need to build working capital. And one other thing that we advocate in Profit First is we take our profit and we will put it in another bank, avoiding the temptation to spend it. We have what's called a profit hold account and a tax hold account. So we put that away so we're not tempted to spend it.
Yeah. While we're on sort of our more technical show, because it's just you and me, the Mastery Profit First professionals, the Mastery Certified Profit First professionals, tell us about working capital and define that for us. We ought to say that every 2 or 3 shows.
The accounting definition of it is your current assets. That's assets that you're going to turn into cash within a year, minus current liabilities, which would be things you have to pay out within 12 months.
Mm-hmm.
And we were talking about this before. Bond agents, underwriters, they will throw out certain things like a prepaid tax, prepaid income taxes, or something like that. They'll throw that all out all day. If you got inventory or something like that, they'll usually throw at least half of that out. There are several categories. If you got loans to the shareholder, that's gone.
Mm-hmm.
So we've got to build working capital. That's one of the main factors that they look at in what you can both bond as well as a banker. Bankers are not usually as sophisticated at pulling that stuff out. They still look at working capital and equity.
Yeah. So from a non-CPA standpoint, working capital, I like to think of it as, okay, let's predict your cash flow. How are you going to be able to pay your bills and not pay your bills in a short term cash flow over the next 12 months? But the problem with that is the way we as a contractor might look at that is a little bit different than the underwriters and the CPAs might look at it, because they've got to they got to cover their ass, right? In case something happens. Because I remember we had a position with a bank that we had a wonderful cash flow because we were steadily selling lots and different things. We were selling assets that we had accumulated over decades. And it was a wonderful cash flow plan because we didn't have to pay any taxes. Who didn't like that? The bank examiners, because they wanted to see a profit. So our logical cash flow part doesn't always mesh with the way they're defining and wanting to see that working capital. That was a bank example, but it's very similar situation for the bonding underwriters, and they've got reasons. They're not just trying to be difficult. I mean, the bankers, their reason is that's what the rule is. The bonding underwriters, they've seen stuff that we hadn't seen, and they are backing us as contractors, and they are going to count what they want to count, what they know historically they need to count. So a contractor says, this is my plan. But They need Wade or somebody like Wade to come help them see through this and communicate back and forth with those bonding underwriters instead of having your own plan. And then it's too late at the end of the year because they needed to be working on this. So you kind of need to let at least your CPA, if you've got that, or perhaps your bonding underwriter, if you can get a really good relationship with them, or your underwriter, or even your agent, if you've got somebody that's really involved like Steven is. But communicate that up front. Don't have your own cash flow plan because it might not be a nice conversation at the end of the year.
Planning is the key. And before the end of the year, you should, I mean, a lot of CPAs don't do this. If they do any planning at all, it's around the tax side. For a contractor, we do a 3-pronged plan at the end of the year. We want to minimize the taxes, but we also want to maximize the financial statement for the bonding company. And sometimes we're on 2 different methods of accounting where we can do that. But the other piece of that is you don't want to screw up your cash flow in January, February, because you made some boneheaded move in December, and then you have no cash to survive in the winter months.
We noticed back, not that I'm showing my gray hair here, but when 2001 came around, it's like all the rules changed. The common sense stuff, that example that I just gave, which always kind of worked in the past, but they like look at it 3 different ways, and they're wanting to make sure the worst case scenario is okay, not the best case
Right.
scenario,
Yeah.
because they don't want to be in a bind. Man, look at the time on this. Wade,
Yeah.
you and I were worried that we were going to have enough to talk about. Man, we look how much we've gone over. This is
Yeah.
great. I could talk about this for a long time.
Well, I know Stephen brought up several other, questions as we were kicking this around. So I think maybe we'll have a few of these discussions.
This is great. And remember, guys, looking at where are you as a profit first contractor, and what does your life look like when you're struggling out there and worried about every paycheck, not knowing the fear, you waking up at 2 or 3 in the morning. I mean, when you get with Wade or me or somebody like that and get that confidence, you're just a totally transformed business. It may take a few months or even a couple of years, but just think about that state of mind that you can be in. And it's not that your company doesn't grow. Think about maybe you can run your company better and maybe even grow more by controlling that cash and keeping it out. Everybody thinks you got to plug that cash in there. But like you mentioned, Jim Collins in his book, in the Flywheel, I forgot the name of it. He talks about these companies looking back that were more conservative on that actually grew faster
Yeah.
because they were healthy. And Mike explains that maybe you find that healthy business in the niche, the fact that you're putting these principles into place, which are less risky, allows you to identify your better niche and your more healthy profit. So over time, when you're in year 5, year 10, you're accelerating a whole lot faster rather than growing unhealthy niches, which I think I had done a few times that didn't really have that profit potential. So the paradox of it looking like you're slowing your growth by taking this money, controlling this stuff versus the paradigm that the more risk you take, the faster you're going to grow. I think that's what we were taught in the 1980s when I was
Mhm.
learning things. Jim Collins was studying and taking all that data, and he said, sorry, guys, that stuff we were telling you, forget that. Grow,
Yeah.
fast growth. If we look back over history for long term growth, it's the people that grow healthy. You have a better
Grow
mindset.
smart.
Yeah,
Yeah.
smart growth. The more risk you take, maybe you'll grow fast in 2 or 3 years, but there's probably going to be a bombshell in there at some point. So anyway, that's my
That's a
soapbox.
topic for another show. I think we can go on
Yeah.
on that one for a while, but
Anyway, gosh, well, wait, I could talk about this all day long. So I guess we got to cut off at some point.
yeah, this
So
has been great.
this is great, and this is the Contractor Success Forum. Don't forget to go to contractorsuccessforum.com. And Wade, you remember what we just talked about? You can scroll up and you see those little show notes there. And now, any of you first time listeners, you know what a magnificent show this is. So look at those 3 little dots down there. click on that and hit that share button and send that to somebody that can use this. Help them out. Be a good buddy to your friend. So appreciate it. Y'all come back, and we miss Steven. Steven, maybe he'll be here on our next episode. So thanks a lot. Wait.
Thanks, Tom.
All right, guys. See you soon.